Good morning. It is so exciting to be here right now. We were last here in May and things were still question marks. I had a pretty bullish presentation at that point about how the trade war was likely going to create the conditions for a bull market, and yay, it worked. So what I think is kind of interesting though is just a month ago at the Sprott conference, the sentiment was still pretty cautious. There are still a lot of people who are not 100% convinced of what is going on. So that's why I wanted to spend my time today talking about why the summer was so good, what happened, and where I think we're going, both in terms of gold itself and then in terms of equities and what to do about it. Okay, I'll keep most of this pretty concise because I feel like most of us are pretty in touch with these kinds of things, but there's a few points that I want to drive home. So really look back the past 12, 18 months and things have been pretty crazy. I mean, we had a full-out trade war breakout between the world's two largest economies. We had the Federal Reserve cut interest rates just this summer. Clear recession signs are emerging, especially in some parts of the world in Europe. Bond yields are doing insane things, and I will talk about that a fair bit. Because of that yield, as part of that, yield curves inverted, which is almost always happens before recessions. Manufacturing is contracted, and then we have, just layering on top of that, we have things like Brexit, we have, tanker seizures, and we have everything that's going on in Hong Kong. It all just kind of came to a head this summer. The pressures had mounted to a point that they could no longer be ignored. And so we had some reaction to that. When I look back over the last 18 months, the S&P is within 1% of where it was at the beginning of 2018. So while we are still focused on, the broad market is still focused on the fact that the S&P is near its all-time high, that's true, but it hasn't gone anywhere in a while. There's been some tradable trends, but a lot of them have happened really quickly, like the crash at the end of 2018 and the surge at the beginning of 2019. Not super tradable. Really, it's been a sideways, volatile thing. What I think is going on is that obviously investors want the bull market to continue. Why wouldn't they? It's been great. And so they buy on any excuse. And so yesterday we had news that, okay, we're going to trade talks are going to start again. And people cheer that and they buy. But in fact, trade talks are a long way from any kind of deal, like a really long way. And investors do understand how real the risks are out there and how strong the pressures are that are working against progress right now, against growth. And we can see that just in things like the fact that the market is right now pricing in 93% odds of another rate cut in just a few weeks. So the understanding is there, even if buying is still going to happen when there's a bit of an excuse. Gold clearly is responding to all of these pressures coming to a head. So gold is up at record highs in like 73 currencies. The thing that underlines for me is the currency war that is currently happening. So as global trade shrinks, countries want to attract what trade there is out there, and an easy way to do that is to have a weaker currency, right? That makes your exports cheaper, and so that makes your exports more attractive. And so there's a race to the bottom with currencies. Obviously, gold is a benefactor of that because it is a counter to such a trade. That said, currencies are all relative. So when everything else is going down, something has to balance it out. So the US dollar has remained resiliently strong, but gold is up 17% despite that strength. And that is a real standout marker of a strong market, right? When gold can gain, it's not just a counter trade to the US dollar, it's gaining in and of itself, it's gaining true value against the US dollar. And usually the primary driver for such a thing is real rates. And I talk about this every time. I'm sorry if I'm boring by bringing up real rates again, but it's one of those boring but true forces that really matter. So the Federal Reserve rate cut was the key thing that tipped the scales in our favor. But while we're talking about rates, what I want to spend a few minutes talking about right now is the fact that the safe haven trade today is different this time. And I hate to use the words different this time because they're overused and usually wrong, and they're usually a trap because it's not usually different. But this time the bond market has made it such that the safe haven trade actually is different than it has ever been before. So we have all these signs of recession. The recession risk is very real. Okay, so people want safety. They want to buy something that is countercyclical and that provides safe returns despite what might happen in the stock market. Usually, most of that money goes into bonds to get yield and countercyclical performance, except that the bond market is completely screwed up. The bond market is not providing what it has always provided, which is yield. Right now, there's $17 trillion worth of bonds, and that's government and corporate bonds. Only 3 months ago, there were no corporate bonds, almost no corporate bonds with negative yield. Now there's $1 trillion worth of corporate bonds with negative yield. Negative yielding bonds don't give big pools of money the 5, 6, 7% returns that they have always relied on. They charge you for holding them instead. So that's really screwed up. And even if you're not in the negative yielding category, bonds just aren't paying very much. So what that means is that the large pools of low risk money that have always relied on bonds for reliable income, that doesn't work anymore. And so they have needed to go somewhere else. For many years now, at least some of that money has gone into the stock market. And it's been one of the big forces that's fueled this bull market to continue for so long, is that big pools of money that didn't used to have such large allocation to stocks did that because they were there for the gains, because bonds weren't really weren't really providing them. But now stocks are only going sideways. 1% over 20 months is not a great return. So if you can't buy bonds for yield and you can't buy stocks for gains, where are these big pools of money supposed to go? Especially when they're looking for safety, gold is one of the only answers there. And that's why I say here, you want to see correlation? That looks like correlation to me. So that is the global market value of negative yielding bonds charted right alongside the price of gold. So guess what? As the pile of negative yielding bonds has grown, guess what the price of gold has done? So I think that that's a really important underlying force. And there's all kinds of fallout effects of this. More detailed, I was chatting with Jay this morning about how that impacts bullion banks and the trades that they've always done. There's a lot of ways that this impacts the gold market. But all of those impacts are positive. All of them are driving money into real gold, not futures, not weird trading, but like buying gold. And while I'm talking about the safe haven argument, I should just address the two things that are usually hits against gold as a safe haven. One of them is that it doesn't pay yield, or it doesn't pay interest. Well, bonds don't either these days, so meh. And the second is that it costs to hold gold. And yes, it still costs to hold physical gold, that's true, but the huge proliferation of alternate ways of holding gold in recent years means that those who are interested in gold can absolutely own gold exposure without having to pay the cost of holding physical gold. So I think the knocks against gold are kind of gone, and instead it sort of stands alone as the safe haven that makes sense. And the other thing is gold as good as a counter-cyclical holding when markets tank compared to bonds over sort of a historical performance? This chart, while it's a bit up and down and all over the place, suggests that yes, gold has in general performed as well as bonds in these periods. And of course, with bonds being so screwed up, I would expect gold to outperform bonds more now than it has before. Okay, so this all means that investors are buying gold, and so are central banks. This is known gold flows with central banks and investors. The bar there for 2019 is really huge, and we're only 2/3 of the way through the year. So the buying is very real. That's a significant bar. That really means a lot. But what matters for those of us here is that we have to remember that this is still early. It's easy to be uncertain about what to do at this point, given that we've been through so many difficult years, given that we've already seen, Kinross is up 60%. Like, oh gosh, have we missed it? Should I sell? What's going on? No, it's still very early days. One way to look at that is to look at how the percentage of investor allocation towards gold right now. So the bottom chart here, if we look at investor holdings in gold, that's the upper chart there, and it's fairly high on an ounces basis. But the lower chart, I think, is more important. So the lower chart, the red line is the S&P, the market cap, is the S&P 500. The gray line is the gold assets under management as a percentage of the S&P market cap. So that's just a way of capturing average investor allocations to gold within their portfolio. And it's still really low, 0.6. At the peak of the last gold market, it was almost 3 times that. So we need to see a significant rotation into gold for things to follow the patterns that they usually follow. It is still early days. There's still a lot of money that needs to come into gold. And as that happens, the thing that stands out about the gold market is how absolutely tiny it is. When you have a whole bunch of dollars that need to come into this tiny, tiny market, they don't have very many places to get stuffed. So the few slots that they're getting stuffed into get full quickly. So share prices really rise when generalist dollars come into gold. And this is a conversation I'm really looking forward to going down to Beaver Creek next week, which is an important conference. There'll be, I'm sure one of the big conversations there will be which funds are present and how, who's new, who's different, because what we need to see are big generalist funds looking for gold exposure. And that's starting to happen. We're starting to hear a fair bit about that. They act a little bit like lemmings. When one of them goes, they all go. So if we can get 1 or 2 big funds to make a significant move into gold, that's what's going to sort of open the floodgates and create the kind of rise that we clearly see is still possible within the sector. So the takeaway message is, yes, we had a great summer. Yes, some miners are already up dramatically. But really, the forces that are propelling gold aren't going away anytime soon. The trade war is not going to get resolved. This crazy bond situation is not going to change. Stock market uncertainty is only increasing as these recession risks hover everywhere. So there's still a long way for gold to go, and investor interest in equities is only just getting started. So that brings me to the 2 questions that I'm getting faced with a lot. If this market is so real, so reliable, so solid, first of all, why aren't more juniors benefiting? And secondly, why does a down day for gold like we had yesterday spawn so much selling? If the market's so robust, then those things shouldn't happen. Well, at the end of the day, I think the answer is this bull market is still young. Those who are already invested, who I'll call like the believers, the dedicated gold investors, when we saw this getting going, you're going to step back and look for, okay, if this is actually getting going after all of this time, where am I going to get the easy first gains? The easy first gains come from the big boys. They come from the major miners, the single asset operators that are takeout targets, and royalty companies. And they have done really well. Like I say, Kinross is up 60%, Newmont is up 60%. These guys have already done well. So those have done well. We're seeing those gains already. And you can't fault some profit taking after everything that we've all been through, right? I think that's fair enough, especially because no market ascends without setback, right? So there's a lot of technicians who are looking at the charts right now who say it's likely that equities are going to give back 20% sometime this fall because the rise has been so steep. Fair enough. That would be a normal part of a rising market. And if that's true, and if you can see that happening, sure, sell now and buy back in 2 weeks after the 20% correction has happened if you can predict it that well. But you can't fault some profit taking because we have seen very significant gains in the big low-risk stocks and in the really select juniors that have been standing out through the sideways market. And so they were the first places that more speculative dollars went as this market got established. But as I said, generalists are just starting to get interested in this market. They're just showing up. As they show up, the gains will continue, and those gains that flood of interest will prompt those of us in this room, the dedicated gold investors, to cycle their profits down into the juniors. And that's when you'll get the rising tide effect where more juniors will benefit. We're still in a divided market. We're still in a situation where the companies that I have been calling the haves, the ones who have it all, who have investor attention, and who did well in the last few years, even though capital was so limited, those have been, they will not be the only stocks that outperform once we get more generalist money in, and therefore more ability to recycle profits back down into the more speculative end of the sector. So how to play from here? all kinds of opinions on this, obviously. My message would be to know your risk tolerance, and within that, know how much time you feel like spending staring at your portfolio, because not all of us want to check in with our gold stocks every day, and that's okay. Some of us spend too much time doing it, and others have other things that they want to focus on. So the message is that in a good gold market, you can get really great returns by holding fairly low risk options, right? And if you don't want to spend a lot of time staring at your gold portfolio, if you don't want to keep up with exploration news, you don't have to. You can own those lower risk options and they will still do very well, and you can check in on it every quarter or something and make moves on that sort of level. The favored producers I call low risk plus, which are the takeout targets, a little bit more risk, but a lot more, but more upside alongside with. And developers, who are actually a fairly small group after this long bear market. If you like to spend time with your portfolio and you also, along with that, have a higher risk tolerance, obviously your spectrum of options gets way larger, and so you look at the strong splashy projects, which are the ones that have this foundational value as an asset advances, but also have the splash of exciting exploration results on the side. And you have really good explorers who are already getting a lot of attention. We've seen that. But as I say, with risk comes the need to pay attention. So just be aware of that. It's easy at a conference like this to get super excited about very speculative, high-risk explorers. And that's great if you want to keep up with their news on a daily basis so that you can take advantage of spikes or get out before drops. But if you don't want to be that engaged, that's also great. You can still make a lot of money without having to dedicate so much time to it. Obviously, I say that I would hope that I could help with whatever end of that spectrum you sit on, because I spend all of my time thinking about these sorts of things. These are the letters that I publish, a weekly, a monthly, and a financing alert service. If you need any more information on that, I would be happy to provide it. I'm here for the next 2 days at your service. And with that, we will move ahead. So after all of that focus on zinc, or all of that focus on gold, let's talk about zinc.